This is FedWatch on Zacks.com. The Federal Open Market Committee has released another decision on interest rates. Well, the Fed has ended its latest two-day meeting during which it examined efforts to curtail this recession and aid the recovery process. As expected, it's pretty much the status quo. Joining me now to discuss this outcome is Zacks Research Director Dirk Van Dyke. Pretty much of a yawner. I mean, they kept the target interbank rate steady in the 0 to 0.25% range, so nothing new there. They said that the economic outlook had improved over the last 6 weeks, but the economy still may remain weak for a time. So
yeah, I mean, you almost wonder, why they bothered. Everybody knew that they weren't going to be raising rates, and mathematically they really can't cut rates. And the statement was almost word for word what they said after the mid-March meeting. A little bit of shading towards, we've been seeing some of these, as they've been saying, green shoots or glimmers of hope in the economy, but certainly not a strong statement in that regard. It was mostly, the economy is still in for some very rough sledding, and they're still more concerned about deflation than inflation, although they don't use the D word. They say the rate of inflation may be below that which is consistent with economic growth and long-term price stability. Again, the Fed tries to use language to hide what it means, not to convey it.
Yeah. They made no changes to their plans to buy treasuries?
No, or to buy mortgage-backed securities, agency paper, or bonds of Fannie and Freddie.
Right.
And that's going to be a pretty significant issue. You're talking about 1.25 trillion worth of agency-backed mortgages. That is a heck of a lot of credit risk for a central bank to take on. I mean, Central Banking 101 says you don't take on any credit risk. Now, they sort of came out not too long ago in their Q&A saying, well, there's not that much credit risk because it's guaranteed by Fannie and Freddie. Let's be serious here.
So while there were no bombshells today, that sounds like one thing you're going to be keeping an eye on.
I mean, this is a major deviation from all the rules of central banking, according to the textbooks, taking on this much credit risk. They are the market for mortgage-backed securities right now. If they were not doing this, mortgage rates wouldn't be below 5%. They'd probably be north of 9%.
And I'm guessing they would argue on the rebound that this is not a textbook recession.
Oh, no, it is far from a textbook recession. And, let's face it, Bernanke pretty much told everybody what he would do in this situation a long time ago, before he became president of the Fed, and that's how he got that nickname of Helicopter Ben. It's, if you're faced with a deflation, then you just turn on the printing presses and quite literally start dropping dollar bills out of helicopters.
Right.
And that is what he, in effect, is doing by expanding the size of the balance sheet in a fashion that has never been seen before in the history of the world.
I saw a story this morning on The Wire, long before the official news came out here this afternoon. The headline was, "Quiet, you'll disturb the recovery." The point being that this latest two-day meeting was pretty quiet, no big hoopla made over it. And that's primarily because the Fed they weren't under any pressure to do anything this time around.
Yeah, well, I mean, they've set all these things in motion, and very dramatic things that they've done. I mean, people who complain that the Fed is sitting around not doing anything are totally missing the boat. The Fed has been extraordinarily aggressive, but now is the time to see if these things work. Monetary policy always works with pretty long and variable lags.
Right. So might we be having a different conversation after the June meeting?
June may still actually be too soon to really tell if it's working, but they may have a little bit more color on whether this incipient green shoots are flowering or have been killed off by a frost. The big frost on the horizon is the incipient or possible bankruptcies of Chrysler and GM,
Right.
which could be really devastating and cause another sharp downturn in the economy.
And let's not forget about the swine flu while we're
And the swine flu. I mean, we also did get the GDP numbers.
Yeah, I find
today.
it kind of curious that this statement comes on the heels almost of that GDP news. Is that curious to you or coincidence?
Kind of coincidence. I mean, obviously they knew about it, and I wouldn't be surprised if they had an advanced peek in their during the meeting where they were discussing these things. But I mean, by and large, it was a pretty ugly report. But at least the good news is that we had a big drawdown in inventories, which sort of lays the seeds for a recovery. But an absolute total collapse in every form of investment, be it residential investment. Residential investment had its biggest subtraction from overall GDP since the third quarter of '06. Now, it's been down 13 quarters in a row.
Right.
And it is such a tiny portion of the economy at this point that its ability to subtract that much was a shocker to me.
All right, I've got to leave it right there. If you want more on those GDP numbers from Dirk, I encourage you to go to Zacks.com's homepage. Check out the blog that he's posted on Zacks.com on that very topic. And I'm sure that if you keep checking back often enough, you'll find a blog from him on this latest Fed outcome as well from this two-day meeting. With Dirk Van Dyke and FedWatch, I'm Terry Ruffalo.